Hello and welcome to AE Accounting Tutorials. We are beginning a new lesson on single entry and incomplete records. That is, we are to learn how to estimate profit or loss from a single entry and incomplete records. This topic has been a headache for most students and I want to simplify everything on this channel. So if you are new to this channel, I will encourage you to kindly subscribe to this channel. You turn on your notification bell so that any moment I upload any new video, you'll get notified on your devices. So when we talk about single entry and incomplete records, it is very simple. Single entry, it is a system of recording business transaction without applying the double entry principles. Or it is a system of recording business transaction that is not in accordance with the double entry principles. You know, the double entry principles, it is the mother of accounting. Everything we do in financial accounting is based on the double entry principles. This double entry principle states that for every business transaction, we have to record it twice. And for every business transaction, it must be recorded in two different sets of accounts. This means that for every debit entry, there must be a corresponding credit entry. And for every credit entry, there must be a corresponding debit entry. For instance, paid rent 500 cedis by cash. So this is a business transaction. The double entry principle is saying that we must have cash account, then we must open the rent account. Every business transaction, we must record it in two different sets of accounts. So let's say the amount is 500 cedis. Because we are paying rent by cash, we have to credit this cash account in the name of rent, let's say 500. Then we debit rent in the name of cash, also 500, to complete the double entry. Meaning that for every credit entry, there must be a corresponding debit entry in another account. This is what the double entry is saying. But here we are looking at a single entry where business transactions are kept that is not in accordance with these principles, of which this principle it is not applied. This means that for entities or businesses that operate this single entry, they just have a single book, let's say a cash book. So whenever they've paid for an expense, they record in that same cash book. Anytime they receive cash, they'll record that transaction in that same cash book without opening the corresponding entry as we've opened rent over here. So because of that, at the end of the period, they will not get the individual balances to extract the trial balance and then to get information from the trial balance to prepare the final accounts. I hope that is clear. So it becomes very difficult as you, a student or an accountant watching this video, to prepare a profit statement from the single entry and incomplete records. So I'm to teach you how you will be able to estimate profit or loss and prepare a statement of financial position when you are given a single entry and incomplete records. Good. So the key difference between the single entry and incomplete records is that with a single entry, the business transactions are kept without applying the double entry principles. The business transactions are recorded that is not in accordance with the double entry. I hope that is clear. But with the incomplete records, it means that the information that is made available or the information provided to you, the accountant or the business student, it is not enough. It is not adequate to prepare the final account. The final account I'm talking about here is the income statement and the statement of financial position. Here, the information is not adequate. Is that okay? So to be able to estimate profits or prepare a profit statement from that, you have to convert the single entry they have done into a double entry. I hope that is clear. Then you have to do some workings, make the other informations relevant available for you to prepare the final account. But let's first of all look at the single entry. But note, there are two basic methods that are used in estimating profits from a single entry and incomplete records. So the two main methods, the first one is the net worth method. So net worth method. Then two, we have convention method. Good. As the name suggests, net worth method, I call this the capital approach. I'll explain to you the reason why this is called the capital approach. Then the convention method is called the income statement approach. The income statement approach. Good. But I'm aware that in some books, they refer the net worth method as a single entry and then the incomplete records as convention method. But that is not my focus. I just want to let you know how you'll be able to prepare a profit statement from a single entry and incomplete records. The first method we have to look at is the net worth method or the capital approach. When you are given transactions of businesses that are operating the single entry, in order to get the profit of such business, what we do basically is to compare the opening capital to that of the closing capital. You know, at the end of the period, the business that operates this single entry system will provide you with the capital he or she has started the business with, and then the closing capital at hand at the close of the period. So you compare the two to determine the profit. So let's say at the end of the accounting period, the capital at hand, the closing capital of the business is 10,000. So I said closing capital is, let's say, $10,000. Good. Then the opening capital the owner has started the business with is, let's say, 6,000. So opening capital becomes 6,000. Good. Now what I'm saying is that using the net worth method or the capital approach, because we are comparing the two capitals, we named it capital approach. So now, as the name suggests, net worth, we are only comparing the difference between the closing capital and the opening capital, and that will be the profit of such business. So the profit becomes 4,000. I hope this is clear. Good. But there are scenarios that may also arise. So let's say at the cost of operating the business that operates this single entry system has introduced additional capital into the business, or he has borrowed money from somewhere or from a friend as additional capital apart from the opening capital and has added to this opening capital to operate the business. So that additional capital that has been added to the opening capital is not part of the business. So to get the true profit, it means you have to take out the additional capital. If additional capital is added or introduced into the business, then the additional capital form part of this net profit. So this will not be the true profit. But if there is no additional capital or drawings, the difference between the two becomes the profit, net profit. So let's say there is additional capital. We have to subtract that. If we did not subtract the additional capital, we would have overstated this net profit. So anytime there is additional capital, we subtract. Additional capital, let's say the additional capital is, let's say, 2,000. Then we have to subtract. Then the balance will now become 2,000. Good. In some cases, the owner of the business may withdraw parts of the capital for personal use. The owner of the business may withdraw that to pay maybe his son university school fees or any other thing. Anytime the owner withdraw part of the capital for his personal use, then we have to add it back, because if the owner of the business did not withdraw such capital, the profit would have been higher than this. So let's say the owner withdraw 500 cedis for his son university school fee. So we have to add the drawings. So add drawings. Let's say 500 cedis. So when we add, the profit will now become 2,500 as net profit. I hope this is clear. But remember, the additional capital will be subtracted. Good. So this is how we estimate profits when we are using the single entry system when you are provided with information. But now, the process of doing this, or the name given to this statement we've done here, is what we call a statement of profit or loss. So let me show you the format of the statement of profit or loss. Then we proceed to look at the conversion method as well. So we look at the format of the statement of profit or loss. So statement of profit or loss for the year ended. Then you write the year in which you are preparing the account. If it is 2024, you write that. Now you bring your currency sign, let's say dollars. Good. I said the first thing to start with is the closing capital. So closing capital, then you bring it. I hope that is clear. Then you subtract the opening capital. So opening capital, we put it in bracket because we are subtracting. So when you subtract, you have this different. If there are no additional capital and drawings, then this will become the net profit. But if there is an additional capital that has been introduced at the course of the period, then we have to subtract. I hope that is clear. So if there is additional capital that has been introduced, or further capital, then we have to subtract that as well. Good. Then if there is drawings, we have to add it. If the owner has withdrawn part of the capital for his or her personal use, we have to add. Then by adding, this particular figure now become the net profit or loss. If this particular answer is positive, then it is a net profit. If it is negative, then it becomes a net loss. So basically, this is how we estimate profits or loss from a single entry and incomplete records. Now, the question is, sometimes the closing capital and the opening capital will not be given to you. Okay, the person or the business operating the single entry system might not provide you with the closing and opening capital. I hope that is clear. Then you have to find a way to find this opening and closing capital. We have something we call statement of affairs. So we use that statement to find what we call the opening and the closing capital, so that we can fix it in the statement of profit or loss to determine or ascertain the profit or loss for the period. I hope this is clear. So let's look at how you'll be able to calculate the opening and closing capital from the statement of affairs. So the determination of the opening and closing capital, it is very simple. This is done from the knowledge from the accounting equation. I hope that is clear. So the accounting equation states that assets equals capital plus liability. I hope this is the accounting equation. Now we are to determine capital. So what do? We make capital the subject. By making capital the subject, you have capital equals assets minus liability. I hope that is clear. We make capital the subject. Now this statement, we are preparing it to find capital. So to prepare this statement of affairs, it is very simple. It is about listing the total asset of the business that operate the single entry system and list the total liability. After that, we subtract the total liability from total assets. The answer we will arrive at, we call that the capital. So in most cases, the question will give you both opening asset and liability and closing asset and liability, so that the opening asset and liability will help you determine the opening capital, then the closing assets and liability will help you determine the closing capital. I hope that is clear. But sometimes one of the capital will be provided, then you have to find the other. So let's see how the statement will be presented. Now, I'm not much interested in the theoretical aspect of this topic. I expect you to read that on your own. My focus is on the calculation or the practice. Now, there are several reasons why businesses run this single entry system. Sometimes because they don't have enough funds to employ competent accountant to run the double entry system for them. Sometimes they are even afraid that if they employed a competent accountant, the person might steal them. So they don't see the need to operate the double entry system. That is why sometimes they keep operating the single entry system. As they continue to operate the single entry system, they find it very difficult to estimate their profit for tax purposes. So we have to help them as students and accountants on how to estimate profits. That is why we are going through all this process. So we said that the statement of affairs, it is just like the accounting equation where we are to determine capital. So capital equals total assets minus total liability. So we just have to list our assets. So by listing the assets, let's respect the classification of assets by beginning with the non-current asset. Good. So with the non-current assets, the business may provide you as many as the business can. So let's say we have land and building. You record that. Okay, now what I want you to do is that we don't need to prepare the statement of affairs twice. That will be waste of time. So when you have to calculate both opening and closing capital, then it will be prudent for you to bring the opening capital here, then the closing capital here. Then you prepare the statement of affairs at once. So this could be opening capital, then this will be closing capital, opening capital. Then you bring, let's say, your currency sign, let's say dollars, then you bring it. But now we are saying that this opening capital, we will calculate this by using the asset and liability at the beginning of the year. So the question will provide you as at 1st January. Then the question will also provide you with the asset and liability as at 31st December. So the opening asset and liability will be used here to estimate or calculate the opening capital. Then the liability and assets as at the close of the period, that is 31st December, will be used to calculate the closing capital. So let's say land and building, the land and building. So let's say we have motor van or motor vehicle. We bring it. Let's say we have furniture. Then we bring it. So you can mention as many as you can. Okay, good. So let's say these are all the non-current assets. Then you have to add it. You add the non-current assets. You underline it once. Good. Then we move to the current asset. So with the current asset, let's say we have inventories. Inventory. Good. At the beginning, then at the close of the period. Opening inventory, closing inventory. Let's say we have receivables. We have receivables. Good. Let's say we have expenses prepaid or expenses paid in advance. Then we have to bring it. Let's say we have income owings or income outstanding. They are all current assets. You have to bring them. Let's say we have cash and bank balance. cash and bank balance. At the beginning and at the close, you have to bring them. Then let's say we add this. We add the current asset as well. Then if this, let's say this is small a, this is small b, then we add the a to the b. We add the a to the b. Then the answer we will have will become the total asset. Now let's look at the liability. So we can bring the current liabilities. With the current liability, let's say we have payables. Then let's say we have expenses owings. You can bring income prepaid as well. So we bring the two here. This is the opening and this is the closing. So let's say this is all the liability. This is all the current liability. So we move to non-current liability. So with the non-current liability, let's say we have long-term loan. So we have the loan here. Then what we have to do is to add the long-term liability to the current liability. So the long-term liability will be added to current liability. This way. Good. So this will become the total liability and this will become the total asset. So let me name here L, here L. So this is total liability, this is total asset. Total liability, total assets. So to get the capitals, so I call this the capital. So we subtract L from A. So it will be A minus L. That is asset minus liability. Then we have the capital. With this first one will become the opening capital. Then this will become the closing capital. Then you can fix in the opening and closing capital into the statement of profit or loss to estimate or ascertain your profit or loss for the period. So basically, this is how we estimate profits under the single entry and incomplete records. In our next video, you will look at the incomplete records into details, where we will be converting the single entry into the double entry system by doing some workings, because we've established that with the incomplete records, the information that will be given to you as a student to prepare the final account will not be adequate, or it will not be enough, where you will not find sales, you will not find purchases. So we have to prepare something we call a creditors ledger control account to determine our credit purchases. We prepare the sales ledger control account to determine the credit sales, and this will help us get enough information to prepare our final accounts. So if you haven't subscribed to this channel and you find that this video has been helpful to you, I will encourage you to kindly subscribe and be part of our YouTube community. See you in my next video.